In March 2026, the leading funeral and cemetery company in North America reported something extraordinary. It has roughly $17 billion of business already sold, but not yet fully delivered. No congested stores, no monthly subscriptions, no merchandise waiting in a warehouse until next week. These were funerals, cremations, cemetery property, items and services acquired before death occurred. Some of the money was sitting in trusts. Some contracts were guaranteed by life insurance coverage. Much of the revenue would not be recorded until later, when the customer died and the funeral home eventually provided the service. That is the hidden prepaid industry inside funeral houses. A funeral home looks to be an emergency service. The phone rings after a death. A family arrives. The director coordinates transportation, paperwork, preparation, a ceremony, burial or cremation, and the family pays. But the most sophisticated operators strive to make the deal long before the emergency. They sell certainty in advance. For the family, that can mean fewer decisions during mourning, a documented plan and protection from potential future price rises. For the funeral home, it might mean a customer obtained years before competitors get an opportunity to talk with the family. But there is a conflict lurking inside that structure. A funeral company can sell a price now, collect or arrange financing today, and promise to deliver the service decades later. The customer sees peace of mind. The business sees a long-term deal. And between the two rests a financial responsibility that has to survive inflation, investment markets, legislation, cancellation, changing consumer preferences, and the funeral home itself. Most people do not buy for funerals frequently. They may choose a funeral home because the family used it before, because it is nearby, because a hospital or friend mentioned it, or because the name has been present in the neighborhood for decades. The transaction also happens under unusual pressure. A family may need transportation immediately. Legal paperwork must be filed. Burial or cremation has to be scheduled. Relatives are traveling. A ceremony may need to happen within days. The client is not comparing televisions on a calm Saturday afternoon. They are making a significant, emotional purchase when time is moving against them. In the United States, the median cost of a funeral, including viewing and burial, was 8,300 NODs in 2023, excluding fees such as the cemetery plot, monument, and some third-party charges. A funeral including viewing and cremation had a median cost of 6,280 TOBs. That bill is not one product. It is a stack of services and merchandise, transfer of the departed, professional arrangements, preparation, facilities and staff, transportation, printed documents, a casket or urn, and the burial or cremation itself. This is why funeral houses often provide packages. A package turns a complex chain of decisions into a recognizable product. Instead of asking a family to create the funeral line by line, the provider can give a traditional service, a burial service, a cremation with ceremony, or a direct cremation option. That has true value. A family may choose a clear path rather than 20 individual decisions. It also has business worth. Packages help simplify processes, safeguard the average transaction, and make services that share staff and facilities easier to sell together. But packages do not erase the consumer's choice to choose. The Federal Trade Commission's funeral rule requires covered providers to give itemized price information. Consumers typically must be permitted to buy only the goods and services they want, although the funeral home may charge a non-declinable basic services fee for planning and common costs. In a 2024 undercover telephone sweep, the FTC particularly advised funeral providers not to promote just package rates when a caller questions about cost. A package can be supplied. It cannot replace the essential itemized information. And that distinction becomes even more essential when the package is sold in advance. A prepaid, or pre-need, contract is created before death occurs. The consumer selects some or all of the future arrangements and chooses how to fund them. At first, this sounds as though the funeral home obtains several $1,000s and can utilize the funds until the funeral goes place. Usually, the system is more constrained. State restrictions vary, but pre-need plans are generally supported in one of two ways. The first is a trust-funded contract. The consumer pays the funeral provider, and state law may require all or a predetermined percentage of that money to be transferred into a trust or escrow account. The money stays associated with a future obligation. The funeral home normally recognizes the service revenue when the product is delivered or the funeral is completed. The second is a insurance-funded contract. The buyer acquires a life insurance or annuity product tied to the funeral arrangement. The policy is anticipated to pay after the consumer dies, helping support the promised services. The funeral home may operate as a sales agent for the insurer and receive a commission when the coverage is sold. This produces two different economic clocks. The funeral itself may be years away, but part of the selling economics can happen today. Service Corporation International, SCI, shows how strong that can become at scale. In 2025, SCI reported about $816.9 million in insurance-funded pre-need sales production across roughly 160,000 contracts. It also reported $292.1 million of general agency revenue, commissions paid from third-party insurance companies for policies issued to support pre-need arrangements. That $292.1 million was revenue, not pure profit. The corporation also incurred sales compensation and other expenses, but the timing counts. SCI can collect commission revenue when the insurance transaction is completed, while the cash intended to support the ultimate funeral arrive when the service is performed. The company advertises its hybrid trust and insurance method as a way to combine the dependable income flow of insurance products with the potential financial upside of trust-funded products. It thinks insurance commissions can offset the selling costs of extending the broader pre-need backlog. The hidden profit engine, therefore, is not simply take the customer's money and invest it. It is more advanced. First, sell the future funeral before the buyer is in acute need. Second, employ a controlled trust, insurance policy, annuity, or approved financial guarantee to support the pledge. Third, earn permissible commissions or retain permitted revenue flows that assist offset the expense of getting the contract. Fourth, develop a backlog of future business that competitors are less likely to capture. And finally, deliver the funeral years later, acknowledging the accompanying service revenue when the commitment is satisfied. At March 31, 2026, SCI reported roughly $17.07 billion in total pre-need funeral and cemetery backlog. Around $12.04 billion linked to funeral contracts and around $5.03 billion to cemetery contracts. The corporation disclosed around $16.82 billion of assets linked with that backlog, including trust investments, receivables, and insurance policies. This does not mean SCI had $17 billion in unlimited cash. It suggests the corporation has a vast pipeline of future revenue, supported by a complicated pool of financial assets and customer obligations. That pipeline is valuable for a reason. Death rates shift from year to year. Individual funeral volumes might move with demography, disease, and local competition. Pre-need sales allow a funeral organization to develop future demand before that demand becomes immediate. A typical retailer concerns whether the customer will return. A funeral home with a funded pre-need contract has already influenced one of the most significant future decisions. And often, the contract accomplishes more than secure one individual. It builds a relationship with the family. When the death occurs, families already know which supplier to call. They may add flowers, catering, transportation, obituary services, improved items, a reception or cemetery products that were not included in the initial package. The prepaid contract establishes the base transaction. The familial relationship can produce the rest. This is why pre-need sales are not only a financial product. They are customer acquisition with an abnormally extended conversion period. The bundle counts because it defines what has actually been promised. A price-guaranteed package may specify that specified funeral home items and services will be given without an additional charge, even if the provider's costs are higher when death occurs. A non-guaranteed plan may simply apply the collected cash toward the future expense, leaving the family accountable for the difference. Third-party expenses can be considered differently again. Cemetery expenses, clergy, flowers, media notifications, permits, and other cash advance things may not be guaranteed, depending on the contract. The FTC warns that survivors may be required to pay additional sums when a prepaid plan does not guarantee future rates, or when the family changes the initial arrangements. So two plans with the same headline price can create quite different promises. One ties the provider into delivering a defined package. The other mainly generates a financed account. For the customer, the terms prepaid funeral can sound final. For the business, every line of the contract matters. This is when the model's greatest strength becomes its fatal vulnerability. Price assures sale certainty. But the funeral home has to produce that assurance throughout time. Suppose a funeral home sells a guaranteed $8,000 package today. The service may not occur for 15 years. During those 15 years, salaries rise. Vehicles grow more pricey. Insurance, utilities, caskets, chemicals, technology, and building maintenance can all cost extra. The funeral home cannot simply send the family a fresh pricing sheet for the guaranteed products. The financial assets behind the contract must increase enough to help absorb that inflation. SCI explains this directly. Investment earnings in pre-need trusts are supposed to minimize the inflationary cost of providing future items and services at the pricing guaranteed when the contract was sold. The term expected bears the risk. If investment returns are weak, if administrative costs are high, if inflation rises faster than the funds, or if the original contract was priced too aggressively, the future funeral may carry a significantly lesser margin than management planned. An effective pre-need program is not only a sales operation, it is asset-liability management. The liability is the future funeral. The assets include the trust investments, insurance benefits, customer payments, receivables, and permissible reserves backing it. The date is unknown since no one knows exactly when each contract will mature. The cost is unknown because no one knows exactly what labor, commodities, or facilities will cost at that moment. And the service cannot be replaced with a digital reimbursement. When the family calls, the supplier needs to perform. There is another danger. The cash are emotionally invisible. A customer pays today, files the documentation, and may not review the arrangement again for years. The family might not even realize the plan exists. The FTC recommends customers to alert relatives about the plan and where its documentation are housed. Otherwise, a family uninformed of the prepaid arrangement could find up purchasing the same services again. Portability and cancellation also differ. Moving to another state, changing funeral homes, or changing the selected arrangements may produce fees, limits, or a different refund depending on the contract and state legislation. In GAO's analysis of state regulation, officials identified drastically varying laws addressing refunds, transfers, trusting requirements, and consumer protection accounts. The buyer may assume they bought complete freedom from future decisions. In actuality, they bought a contract whose safeguards depend on its funding method, guarantee language, and local regulation. And when that system is exploited, the repercussions can be catastrophic. National prearranged services provided prepaid funeral contracts in many jurisdictions, and stated that consumer monies would be protected in trusts or insurance policies. Federal prosecutors later stated corporate leaders abused funds and insurance premiums during a conspiracy that stretched for more than 15 years. In 2013, 6 offenders were sentenced on fraud, money laundering, and associated counts. The Justice Department said the scheme deceived more than 97,000 customers across more than 16 states, hundreds of funeral homes, and multiple financial institutions, causing more than $450 million in losses. The families had not just lost an investment account, they had paid to remove a future burden from their relatives. The scam returned that load at the worst conceivable moment. That case featured criminal misbehavior. It does not represent the conventional pre-need business model, but it explains why states require trusts, insurance funding, licensing, reporting, and other protections. The product hinges on assurance that money spent today will still finance a funeral years later. Trust is not a marketing accessory. It is the asset holding the entire firm together. Even when the finance is sound, the product being promised is changing. The American funeral is becoming less traditional. The National Funeral Directors Association estimated a 63.4% U.S. cremation rate for 2025, compared with a burial rate of 31.6%. Cremation services normally cost less than funerals involving burial, and direct cremation can omit viewing, embalming, ceremony, casket, hearse, and other revenue-producing elements. That increases strain on funeral homes structured around traditional offerings. A pre-need plan helps secure future market share. But if the bundle portrays a funeral customers no longer want, it may preserve the incorrect revenue. A consumer who signed a standard plan years previously may eventually desire a simpler cremation. A family may desire a tribute in a restaurant, outdoors or online, rather than inside the funeral home. The provider must reconcile the constancy of standardized packages with the reality that rituals vary. The strongest operators do not see cremation as the absence of a funeral. They build packages around memorial services, receptions, bespoke urns, souvenirs, webcasting, witness cremations, scattering rituals, and other forms of memory. The body's final disposition may become easier. The family's need to assemble, remember, and manage logistics does not evaporate. The good funeral home explains clearly what is assured, where the money goes, what happens if the customer moves, which items can alter, how refunds operate, and what the family should expect at the time of death. It prices the package conservatively. It uses respected trusts or insurers. It retains accurate records. It modifies the service when client preferences change. And it sees pre-need as a promise to a future family, not merely a sales objective for now. The terrible version focuses on the contract value. It makes the bundle sound more complete than it is. It hides non-guaranteed elements under reassuring phrasing. It depends on hopeful investment growth. It pays aggressive selling costs to produce backlog, and it expects the customer will not raise challenging questions because the service is far away. Both approaches can produce a sale today. Only one is establishing a durable business. So where is the main profit engine inside a funeral home? It is not merely the casket. It is not the embalming room. And it is not the cash gathered from a mourning family after a death. The hidden engine is the capacity to secure the relationship before the need exists, package the future service, fund it through a regulated financial product, earn permissible economics during the sale, and convert that contract into future revenue when the service is eventually delivered. That can give a funeral organization reliable backlog, reducing customer acquisition uncertainty, insurance commissions, and a long-term link to the family. But the same engine generates the model's single greatest flaw. The funeral home is offering assurance about a cost it cannot completely know, on a date it cannot foresee, using money it typically cannot freely access. The deal is signed in the present. The expense arrives in the future. And the reputation of the firm hinges on those two numbers remaining matching when a family eventually makes the call. The funeral is what the public sees. The hidden business is the promise sold years before it.